You know, when you board a commercial flight, you don't really think about the millions of lines of code or the complex aerodynamic physics keeping you in the air.
Right, you just want to get to your destination.
Exactly. You just trust the machinery. But then,
Yeah.
you decide to buy a house, and suddenly it's like you aren't just a passenger anymore.
Oh, you are shoved right into the cockpit.
Yes, you're in the pilot seat. There are hundreds of flashing lights, this massive alphabet soup of acronyms staring back at you. And I mean, if you press the wrong button, your entire financial future could just go into a tailspin.
It is the absolute definition of a financial black box. I mean, the mortgage industry is incredibly intimidating, and frankly, to the average person, it feels like it operates behind this wall of deliberate complexity.
Which is exactly why we're here. Welcome to the deep dive. For you listening, today's mission is to crack open that black box and really shortcut your understanding of home financing.
And to do this, we're looking at a very specific, grounded set of sources, not just, abstract economic theory.
Right. We're looking at the website copy, some corporate blog posts, and honestly, the most revealing part is the actual customer reviews of a specific local Florida lender. They're called ACE Mortgage Loan Corp.
Based down in Coral Springs, and they've been operating since 1996.
Yep.
Analyzing a localized lender like this rather than some faceless national bank gives us a perfect microcosm.
Oh, totally. We get to see how the industry actually operates on the ground level. Like, we can see the friction between the sterile financial products they sell and the messy real lives of the people buying them. So, okay, let's unpack this.
Let's do it.
Because the sheer variety of options out there is just staggering. When you look at Ace Mortgage's portfolio, you are immediately hit with this overwhelming menu.
Oh, yeah. FHA, VA, ARMs, conventional jumbo loans. It is a lot to take in.
It's huge. And before we even talk about interest rates, we really need to understand what these products actually do. Like, let's start with conventional loans, specifically Fannie Mae and Freddie Mac.
Right, the big ones.
We hear those names constantly, but what are they mechanically doing in the background?
Well, that is the core of the entire system. Fannie Mae and Freddie Mac, they do not lend money directly to you. You have to think of them as the secondary market.
Okay, so how does that work for a local place like Ace?
So if Ace Mortgage has, say, $10 million in the bank, and they lend all of it out to 20 home buyers, Ace is now out of cash.
Right.
They cannot issue any more loans.
They're just frozen.
Exactly.
Yeah.
But then Fannie and Freddie step in and buy those 20 loans from Ace. They hand Ace $10 million in fresh cash, plus a little extra, and now Ace can turn around and lend to the next 20 people in Coral Springs.
Oh, wow. Okay, I see.
And this is the massive catch, because Fannie and Freddie are buying these loans, they get to set extremely strict, rigid rules on what a safe loan looks like.
Oh,
If you don't fit their exact mathematical mold, they won't buy it.
which completely explains why all these other loan types have to exist. I mean,
Right.
if you don't fit that perfect Fannie Mae mold, you need an alternative.
Precisely. Like the FHA loan they offer.
Right, the Federal Housing Administration. The sources note they back these loans, allowing for up to 96.5% financing, meaning you only need a 3.5% down payment.
Yeah. And it's heavily utilized by first-time buyers or, people with less than perfect credit.
Because mechanically, the government is stepping in to insure the local lender. They're basically saying, hey, if this borrower defaults, we will cover the loss, so go ahead and take a chance on them.
What's fascinating here is that local lenders aren't just selling money. They're acting as localized financial matchmakers.
Matchmakers, I like that.
Yeah, because different loans serve completely different economic realities. There's absolutely no such thing as a standard home buyer. Just look at the VA loans they offer.
Right, for veterans and active duty military, those provide 100% financing and zero private mortgage insurance, which is just huge.
It's massive.
Yeah.
The government guarantees a portion of that loan, which entirely changes the risk calculus for the lender.
And then on the total opposite end of the spectrum, you have jumbo loans. Our sources mention ACE provides these through private equity or portfolio lending.
Right, for luxury properties or if you just live in a highly expensive market.
Yeah, because if you're buying something that expensive, you blow right past the maximum loan limits that Fannie and Freddie will even touch. So lenders use jumbo loans, which don't get sold off to those government-backed agencies.
Exactly. They stay on the books of private investors, which means the investors can actually be more flexible with credit scores, if you happen to have a lot of cash reserves.
To me, looking at all this, it's kind of like choosing the right vehicle for a specific expedition.
Oh, that's a really good way to look at it.
Yeah, like an adjustable rate mortgage, an ARM. It's kind of like leasing a sports car when you know you're only staying in the city for a few years. It's fast, maybe cheaper up front, but you wouldn't take it off-roading.
Right, because the terms can shift on you.
Exactly. Whereas a fixed-rate conventional loan is like buying a reliable 4x4 that you plan to drive for a decade. It's stable, predictable. But, and this is what I'm wondering, why does a local lender need such a massive, diverse portfolio of loan types?
Well, because of what we said earlier, there is no standard buyer. May Urim, a Florida teacher, left a review in early 2025 that perfectly illustrates this matchmaking.
Oh, yeah, I remember that one.
She didn't just get a standard loan. She specifically praised a Hometown Hero grant initiative that Ace Mortgage helped her navigate.
Wow. So you aren't just walking into a bank and pulling a loan off the shelf. You are navigating this highly customized maze, which naturally transitions us to the
A
cost.
price tag.
Yes.
Because moving from what kind of loan you get to how much it actually costs you is where the real friction happens. Customized loans lead to customized interest rates.
And this is where the average home buyer gets incredibly frustrated. Which brings us to a blog post in our sources by Scott Osher, who writes for Ace Mortgage.
Right, the one titled, But My Neighbor Got. Yeah, the title alone tells you everything. He addresses this massive consumer blind spot, this illusion that interest rates are universal.
People just assume they are.
Exactly. Osher writes, but my neighbor got 2%. And his response is essentially, no, they didn't, and even if they did, you aren't them.
It's so blunt. The source explicitly states that bankers and brokers do not just make interest rates, the individual does.
Yes, it's human nature to compare your deal with the guy next door, but it reflects a fundamental misunderstanding of how money is priced.
Wait, hold on. Let me push back on Osher's claim for a second.
Sure, go ahead.
If lenders don't just make the rates, and we're constantly hearing on the news about macroeconomics, the Federal Reserve raising rates, inflation spiking, global markets shifting, how can the source claim that the individual makes the rate? We are entirely at the mercy of the macroeconomy.
Okay, that's a very fair point. Let's separate the two gears turning here.
Okay.
Think of the macroeconomics, what the Fed does, global inflation, as setting the absolute baseline floor. They build the foundation.
Right, the absolute minimum cost of money.
But your microeconomics, your specific personal data determines how many floors up from that baseline your specific interest rate will be built.
Oh, okay, so it's about the risk premium.
Precisely. So to anyone listening right now, if you're wondering why your rate quote was higher than a friend's, you have to look at the risk matrix. Two people can buy identical houses on the exact same street on the same day.
But they get wildly different rates.
Exactly, because if your neighbor is putting 20% down on a conventional fixed-rate loan with an 800 credit score and you are using an FHA loan with 3.5% down and a 650 credit score.
You present a drastically higher statistical risk of default.
Yes, and the lender mathematically must charge you more for the same amount of money to offset that risk. This is why consumer protection exists.
Right. The source material brings up the Consumer Financial Protection Bureau, the CFPB. They heavily regulate this exact math.
Because the calculation of your rate is so highly individualized, it's inherently opaque to the consumer. So lending is a heavily regulated calculation, not a one-size-fits-all price tag at a grocery store.
The CFPB exists to enforce transparency, making sure lenders aren't arbitrarily punishing borrowers. But, those rules aren't static.
No, they change. And Osher's blog mentions a massive regulatory shift coming from the CFPB regarding the elimination of something called the GSE patch.
Right. He warns clients that this hard deadline will have a tremendous effect on consumers' ability to buy or refinance. We really need to explain this weed because it sounds incredibly dry, but it literally dictates who gets to own a home. What actually is the GSE patch?
Let's look at the mechanics. GSE stands for Government-Sponsored Enterprise, our friends Fannie Mae and Freddie Mac. We established they have rigid rules, right?
Yeah.
One of their strictest rules is the debt-to-income ratio, or DTI.
Meaning how much of your monthly income goes toward paying off debts.
Exactly.
Yeah.
Historically, the hard limit was 43%. If your total monthly debts, including the new mortgage, took up more than 43% of your income, Fannie and Freddie wouldn't touch the loan.
It was just considered unsafe.
Right. However, the CFPB implemented a patch, a temporary loophole. This patch allowed Fannie and Freddie to buy loans that exceeded that 43% limit, provided they met a few other compensating criteria, like running it through a specific automated underwriting system.
So it provided flexibility for people carrying a bit more debt. Maybe they had student loans or heavy car payments, but it allowed them to still buy a house.
Yes. Now, eliminate that patch. Suddenly, that 43% hard cutoff is reinstated across the board.
Yeah.
The math changes overnight.
Wow.
Borrowers who would have easily qualified last month are suddenly denied because their debt-to-income ratio is, say, 44%.
That is wild. So a shift in federal regulatory policy instantly trickles down to a buyer in Coral Springs getting rejected.
Exactly.
Which means if the rules dictating whether you even qualify for a loan are shifting under your feet like that, getting from an approved application to actually holding the keys must be an absolute gauntlet.
Oh, absolutely. The modern mortgage process is essentially essentially an obstacle course of bureaucracy.
Here's where it gets really interesting. When you read the corporate copy on ACE's website, it's very sterile.
Lots of jargon.
Yeah. We're talking about NMLS numbers, which
Wow.
is basically a giant registry for loan officers. We're talking about debt to income ratios, Fannie Mae, risk premiums. It is all cold, hard, objective math. But then you look at the customer reviews and the contrast is just jarring.
Because buying a home is arguably the most stressful, emotional, financial transaction of a person's life.
Right.
The math is sterile, but the reality of moving your family is not.
Exactly. And there's another article by Scott Osher in our sources titled, "Are We Closing Tomorrow?" He describes this nightmare scenario perfectly.
It's so stressful to even think about.
Right. Imagine the moving truck is sitting in your driveway, everything you own is in cardboard boxes, and you get the call. You are not closing tomorrow.
He describes the immediate consumer reaction as dead silence followed by internal rage. You start asking, how did this happen? Who missed a deadline? Why am I finding out now?
It brings up this glaring paradox. We live in an era of automated underwriting. Ace Mortgage literally offers free, instant automated calculators on their homepage. Algorithms are processing the bulk of this data,
Yeah.
yet does the survival of a home purchase actually just come down to having a professional bulldog in your corner?
If we connect this to the bigger picture, the answer is unequivocally yes. As lending algorithms become more complex and rigid, the need for human loan officers actually increases.
Wait, really? Why?
Because only a human can contextualize a nuanced financial life to a rigid machine. You need a failsafe.
And according to the customer reviews, Ace Mortgage has a legendary failsafe named Kelly.
Oh, the legend of Kelly Ardito.
Yes, these reviews are incredible case studies in overcoming the algorithm. Take Amanda Monk's review from December 2021.
Right.
She starts off by admitting she had downright horrible credit. Now, an automated system would just scan her credit file, spit out a rejection screen, and the transaction would end right there.
But Kelly intervened. The review details how she didn't just reject them, she actually provided a step-by-step plan to repair their credit to hit the exact metric the algorithm required.
And once the score hit the target, they got a pre-approval just 24 hours later and closed the loan in 3 weeks.
That is fast.
Yeah. But the most revealing detail in Amanda's review is what happened at the very end. She notes that even when the loan was fully approved and closed on Kelly's end, Kelly, and this is a direct quote, dragged the title agent to the finish line to make sure everyone was able to walk away happy.
Let's contextualize why a title agent would even need dragging. A title agent's job is to ensure the seller actually owns the house free and clear, with no hidden liens or claims against it.
Right, lots of paperwork.
Tons. It involves tracking down municipal records, paying off old debts, coordinating massive amounts of files. It is inherently prone to bureaucratic delays.
And Amanda mentions they didn't even have a realtor, so the loan officer just rolled up her sleeves, stepped entirely outside her job description of calculating interest rates, and forced the logistics to happen.
An automated web calculator cannot drag a title agent to a closing table.
No, it can't. It's such a visceral image.
It proves that in high-stakes financial transactions, automation hasn't replaced the need for human grit and advocacy.
We see the exact same thing in a review from Raquel Maldonado in 2023. She praises Kelly's extreme responsiveness, taking calls after hours, working on weekends, constantly texting updates.
Yet Raquel wrote that Kelly and her team took them to the finish line with unmatched determination. When was the last time you heard someone use the phrase unmatched determination to describe a bank?
Right. Never. It ties back directly to Ace Mortgage's official company motto, relationship banking lives here.
Which, when you read that on a homepage, it just sounds like standard hollow marketing speak.
Yeah, total fluff.
But when you read the reviews, you realize the relationship is actually the engine that makes the transaction happen. The loan officer acts as an emotional and logistical buffer between the buyer and the unyielding bureaucracy of the lending system.
So for you listening, we've covered a massive amount of ground today, cracking open this black box. We decoded the mechanics of the mortgage menu, from the government insurance of FHA loans to the strict secondary market of Fannie Mae and Freddie Mac.
We really did.
We shatter the illusion of the neighbor's interest rate, learning how your personal microeconomic fingerprint sets the final price of your loan, and how regulatory shifts like the GSE patch elimination can change the math overnight.
And we discovered through the customer reviews that the ultimate fail-safe in real estate isn't an algorithm. It's a fiercely dedicated human advocate. The reason this deep dive matters to you, whether you're prepping to buy a house or just trying to understand how massive financial systems actually operate, is all about leverage.
Leverage.
Yes. Once you understand that you hold the power to shape your interest rate through your own financial habits, and you accept that you absolutely need a human advocate to navigate the inevitable friction, the entire intimidating process is demystified.
It takes you out of the passenger seat and puts you squarely behind the controls.
Exactly.
But I want to leave you with one final thought to mull over. If a single dedicated human being, one loan officer, working weekends, and physically dragging title agents across the finish line can mean the difference between a denied application and a family moving into their new home.
Yeah,
What does that actually say about the supposedly objective math-based algorithms that run our modern financial world? Maybe the math isn't the final word after all.
that's a great point to end on.
Thank you for joining us on this deep dive. Next time you stare at a confusing mortgage calculator, just remember, somewhere behind the flashing lights and the alphabet soup, you still need someone to help fly the plane.